Think about all the major milestones in your life. I know I think about these ones all the time. Each special moment needed a unique investing strategy to make it possible. And your asset allocation is one of the most important decisions you're going to make in the process. So how can you get it right every time? Well, we're about to find out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to DIY investing with insights from savvy everyday investors and financial pros. Presented to you by TD Direct Investing, named Canada's top online broker in 2026 by Money Sense Magazine. I'm your host, Rob Moise. And asset allocation, of course, can be a very tricky thing to get right because everybody's got unique financial circumstances, needs, goals, but there are some fantastic rules of thumb to consider to help you decide on yours. We want you to get in on the conversation as well during our live viewer Q&A session, so make sure you let us know how you're managing your own asset allocation, what you think about today's discussion and what you heard. There are plenty of ways to have your say, so don't miss your chance to weigh in on today's topic, and of course have your burning questions about investing answered. You can submit your questions to us anytime during the show. Joining us is Alain Desbiens. He is the Vice Chair of BMO ETFs. Alain, it's great to have you in studio with us. Appreciate you taking the time.
Thank you for the invitation, Rob.
Absolutely. All the way from Montreal. We appreciate you coming in here. I think, just like let's set the table for our viewers here. Asset allocation, why is it so influential to actually reaching your financial goals or not?
Maybe a couple of key points. That allows you to determine, a portfolio and the risk return profile. This is really key. I would say also it aligns the investment of the portfolio with your financial goal and the time horizon. It's supposed to be diversified broadly, so it helps reduce, the concentration risk in one stock, one sector, one country, or one asset class. And it helps the investors stay disciplined. Think about, the long term and the time horizon. So those are really key things, and it helps balance like the growth, income, risk return profile with the behavior. So this is really key to financial success.
Mm-hmm. And I think one of the things that people often struggle with is that, you have all these different financial goals. They each have different priorities in your life and timelines and stuff like that. So can you maybe give people a sense of, what sort of investments, generally speaking, suit longer term goals versus shorter term goals and everything in between?
It's funny because 2 weeks ago I had a discussion with Rob Carrick about this, and we spoke about goals. And for me, there's like the ultra short-term goals. That's called emergency fund. This is so key to financial success. The short-term goals, so basically less than 3 years, like car purchase. I saw you in a car right there. Vacation, down payment. Midterm goals like I saw a little kid, Vanessa.
That's right.
So funding the child education. Or, long-term retirement needs or wealth creation. So different goals with different times horizon, with different asset mix. So this is really key.
So if it's like, let's say stocks, for instance, everybody thinks, stocks, they generally speaking have the highest expected return. Is that something that you can use for a short-term goal, or is it something that, is mostly for a long-term goal? How do you think about that?
Well, ultra short-term goals like emergency fund you should be able to cash that in a couple of days. So money market ETF, cashable GICs only. Short-term goals like less than 3 years, I would not put equity in it. I would put only like maybe a ladder of GICs or short-term fixed income ETF and cash. It's really when you go midterm that you should think about including some equity component of it. So, with midterm goals or long-term goals, you should think about including equity. But indeed, you need to answer the investor questionnaire. This is really key around the asset allocation. So this is for me really key. Like, do first the investor questionnaires. Investor questionnaires, this is all about time horizon. And you'll see from there, which kind of asset mix you should have. But there's really, for me, 4 types of different goals. The ultra short one, the emergency fund, the short less than 3 years. Those one I don't think you should have equity in. Historically, we've seen period of 3 years where even an income portfolio with a small equity allocation turn out negative. So if you want to make sure to be okay, I would use equity for the midterm and the long-term objective.
Okay, so that's a good rule of thumb to keep in mind. Are there any other ones, regardless of asset allocation, that you think should be really top of mind for investors?
Well, there's several ones. Like you should first do the investor questionnaire. After that, you should align the portfolio with the risk and return profile. You should diversify broadly on the equity side and on the fixed income side. On the equity with diversified Canadian, US, EFI, emerging equity. On the fixed income side with Canadian and foreign. You should rebalance periodically. So this is really key. You should focus on cost and taxes because, especially for someone young like you, like 37, I think, you've got multi-decade in front of you of compounding returns. So cost and taxes is really important in the overall return. I would stay disciplined. I would maintain realistic expectation. I would review and adapt when life changed. Probably already at 37, you had to do it with the new kid, with when you're married. So we need to tackle multiple objectives. So we need to review and we need to adapt.
I really appreciate you considering me in the young investor category.
Oh, yes.
I don't always feel that way. But with that said, I want to get into some of the case studies that we're going to talk about for different stages of your life and asset allocations. But right before we get into that, you're an ETF guy, of course.
Yep.
And one of the products that's out there that investors can consider are these asset allocation ETFs. BMO is one of the companies that has these, many others do as well. Why do you feel like these can be such a great tool for investors, regardless of what your age is, regardless of what milestone you're investing?
I don't think we realize how important it is in Canada, that space. At the end of December 2025, the sum of all the Canadians' registered and non-registered money was $8.5 trillion. That's a lot of money. There was $1.1 trillion invested in balanced or asset allocation mutual funds. ETF asset allocation was roughly $50 billion. So there's $1.08 of Canadians that are invested in those balance and asset allocation. And I think on the ETF side, asset allocation ETF have really distinct, characteristics and benefits. It's an all-in-one solution. You're diversified in several ETF that covers all the space, all the geographics. This is one ticker per asset model. So this is really important. It's rebalanced automatically. So, when some part of the portfolio did appreciate, you don't fall in love with an asset class or a stock, it gets rebalanced. It keeps you disciplined. So I think this is all good things there. So some providers are using index ETF. Others are using factor ETF. Others are using active ETF inside of the asset allocation. So that's good to compare. Some are using some alt inside. We choose to focus on cost and taxes. Like we've lowered the fees in June last year at 15 beeps. And we focus on taxation because 2/3 of that $8.5 trillion of money in Canada is in taxable account. So people were telling us, what can we do? So on the fixed income side, we've used ZDB, which is a discount bond that gives you a better tax profile. This is a tax-aware bond that helps you alleviate a bit the taxation of the interest income versus a bond with the same characteristics. And we're aging. You're young, you're 37, I'm 62, so I'm a boomer. So there's a lot of boomer in Canada that goes into a decumulation phase. So more and more we see asset allocation with T-Series. We have T-Series on 3 of our ETF that allows you to have a higher monthly cash payment that allows you also maybe potentially to benefit of some tax efficiency depending of the nature of the distribution. But also because if you go on asset allocation model right now, the income generated sometimes is below 2%. So when you go inside of that decumulation phase, you need a higher payout. So T-Series are really, really efficient there.
Yeah, and we're going to get into some of those specific ETFs a little bit later in our conversation, but let's get into some of those case studies because it sounds like asset allocation ETFs can be something that can fit potentially every stage here, but let's get into some of the case studies. Let's start with a younger investor. I made the cutoff age 35, so I don't quite qualify here, but let's say they're saving for retirement. What do you think their asset allocation might want to look like, generally speaking?
And indeed, because it's education, I'll say to everyone, do the investor questionnaires. So this is, CSIRO has a good one, the Canadian Investment Regulatory Organization. They've got some, investor questionnaire where you can put different goals, different time horizon. I think we should be goal-based there. But the big advantage of someone young like you or below 30 years old is the time horizon. You can compound decades of return during your accumulation and decumulation. FP Canada, Financial Planners of Canada, do each year some assumption. They use mortality table. So I've checked yours. So at 37 years old, you've got a 50% chance to live up to 90 years old. But because you're married and a couple, for men, it adds a couple of extra years with a 50% survival rate. But if you've got a serious plan, people will do it with a 25% survival probability because you've got one chance on two to live, longer than this. So in your case, you're planning for 95 years old. And because you're in a couple, it's 98 years old. So there's decades in front of you of accumulation period and decumulation. So I would say for someone young, the big thing for them working to the advantage is the time in front of them. This is huge. So you can afford to have a bigger equity proportion inside of your asset allocation. But again, I've been touring, Canada in the past year. I've met more than 2,000 investors, and I'm always amazed to see that it's not all the millennials that have the same risk profile, and there's not all the boomers that are only in income. So each of us are different. So you should not compare yourself to people of your age. This is really important that you do your own assessment about what fits you, because you know what? A good plan followed constantly is better than a so-called perfect plan frequently abandoned.
That's a really good point, because we don't exist on paper, right? We're real people with emotions, and if you're not comfortable ultimately with whatever looks best on paper, it's not best for you, right?
But indeed, a young one could have an 80-20, 80% equity, 20% fixed income, or 100% equity if they've got a good emergency fund. That's for me the foundation on which you can build a long-term growth, because you don't frequently abandon your plan because you didn't have an emergency fund and you need money. So this is the first thing we should build in our financial independence. And after that, you plan for the future.
Yeah, phenomenal point. And I always think of the emergency fund as like insurance. Like nobody wants to have insurance until you need insurance, and then it's great. One thing I hear some young investors say is, I don't want to invest in things like bonds and GICs and stuff like that, because I have that longer time frame, right? So I can just kind of put up with the volatility of stocks and go heavy into that. Do you think that there is a place for fixed income products in a young person's portfolio?
Indeed. So first, in the emergency fund. And, we all tackle, depending on our age, multiple financial goals. So if you've got a goal less than 3 years, like car purchase, vacation, home renovation, you should think about cash and fixed income. But indeed, if it's to educate, children, if it's for retirement, building wealth, this is different. But I think cash and fixed income makes sense because we've got several goals across all the year. And don't forget, we'll need to review and adapt because there's always new financial goal coming in our life.
What about specifically for retirement, if they're investing for retirement?
So if their investor profile gives them the profile that looks like a growth profile, an all equity, yes, I think they could have a diversified portfolio of Canadian, US, EFI, and emerging equity. And sometimes, couple with a bit of fixed income if it helps them stay disciplined and stay committed to their plan. Because again, a plan followed constantly is better than a perfect plan where I'm supposed to be 100% equity, but I cannot resist the volatility inside of the solution that I'm choosing. So this is really key.
You mentioned buying a home as one of the goals that a young person might have. So speaking of which, let's say I'm saving and investing for a home. What kind of asset allocation might I want for a goal like that?
It depends when you'll need the money. If you need the money between 3 to 10 years, you can have an allocation inside of the equity. But if it's less than 3 years, no one wants to see their home purchase fund drop 10, 20%. 6 months before the purchase. But if it's after 3 years, 5 years, 7 years, if it's a mid or a long-term goal, yes, you can have an equity allocation. But if you're ready to make the home purchase in 6 months, 1 year, 2 years, that should be in cash and fixed income.
If it's a little bit of a longer time frame, how heavy, generally speaking, do you think it makes sense to go on the equity side of things? Like, is there a sort of an invisible ceiling that kind of makes sense?
Well, you always need to look at the risk return solution and asset mix that you're bringing. So this is why I like asset allocation ETF, because often you can see year over year what were their annual returns. So you can see if you've got the stomach for that. And they always showcase in the ETF facts the 3 months, best return, worst return. So again, there you can see if you can stomach it. But I would see a long-term creation well planned with an 80-20 or 100% if the emergency fund is there. This is really key, because on investment forum, and I'm sure you're looking at investment forum like me, sometimes when we see huge day, like when we see the tariff day of Mr. Trump, like when we see the beginning of the war in Iran, we see some people in investor forums says, oh my God, I had invested in that 100% equity asset allocation ETF, but I don't have an emergency fund. What am I doing? Oh, I need some money. So when there's volatility. So again, and there's one key message, I still think for a wealth creation plan, having that emergency fund allows you to build a better probably equity position, a better growth position for the long term, because you've got that safety there.
Right. That's a great rule of thumb. I love that one. Let's get to our middle-aged investor. Now, I technically qualify for this one now. This is, let's say, 35 to 55. How might they want to change their asset allocation, again, if they're saving for retirement versus what they were doing when they were younger?
Well, for someone that is 35, they've got 50 years of accumulation and decumulation. So they can have, like 55-year-old, this is near my age, I'm 62. At 55, you still have like 30, 35 years of accumulation and decumulation. So if your investor profile gives you those characteristics and you've got the stomach for it, you can invest in a balance, a growth, or an all equity asset allocation model. So a 60-40, 80-20, 20-80. So that makes a lot of sense.
So keep some of the pedal to the metal, so to speak, on the equity side of things.
Though when you arrive to the accumulation to the decumulation, maybe think about reducing a bit the equity portion and build a better presence on the cash allocation and the fixed income to avoid what I call the sequence of return. That when you need the money, you are in the 1, 2, 3 years of bad return, so you need to take some loss. So what I see is people, when they're passing 60 years old, they're building a bigger cash reserve, a bigger fixed income reserve, so maybe going from a 100% equity to a 80-20 or 80-20 to a 60-40 to be sure they avoid that sequence of return impact on their portfolio. They can always go back to cash or the fixed income if the market is bad.
Speaking of that, is it?
I'm talking to me, by the way, when I'm saying that here, because I'm 62. So I need to plan according to this. But when we're 35, we've got 5 decades of return in front of us.
You got the runway.
We don't think about it, but approaching 55, 60, you're approaching of the pre-retirement phase. So you need to think about it.
But so in terms of dialing things back towards fixed income as you get sort of later in that age range, is it? You think, generally speaking, best to just kind of flip the switch and go I go 80-20 or I go to 60-40? Or do you do it gradually in a step
kind
of way?
I would do it gradually. It's not like a light switch I'm 65, I need to go 40-60 and I was 100% equity. And, again, I've met tons of investors across my career, and the last year I've met a lot. I'm always surprised about people over 80 that are 100% equity. They have their cash emergency fund. But I don't think it's just a question of age. It's really do your investor profile, understand who you are as an investor. But it's different. I think the big thing is to pass from an accumulation to decumulation. And again, if I look at the big broad equity diversified basket, whichever they're active or whichever they're index, they're generating less than 2 or 1% return. S&P is not even generating 1% of dividend income. So you need to think about what's my plan to begin taking some income from that wealth. So some decumulation strategy are really key.
One of the other things for middle-aged investors, they're going to be saving for a kid's education.
Yeah.
I know I certainly am. It's one of the first things I did, open as RESP when my daughter was born. How do you think about asset allocation for a goal like that? Because it's like a long-term goal in a lot of respects, but that time flies in a hurry.
So it depends when you'll need the money. When is going to be the withdrawal? Because there's a deadline. At one point, the kids is going to need his tuition bill to be paid. They're going to be in a post. I know you cannot see Vanessa right now in this, but one day she's going to grow older and she's going to go to university. So if you're at 10 years of the withdrawal, you can have a better equity portion of it. But if you're at 3 years, 5 years, you need to make sure that you've got some cash, you've got some fixed income to pay the bills. And again, a bit like for the down payment for a home, you don't want to see that money drop 10, 20% if you're at 6 months of beginning to pay the bill, because you're going to have that sequence of return that is going to play against you. So cash and fixed income are not drag. They're a tool to help us build that wealth and maintain that wealth over time.
That's a good way to think about it. Now, with the RESP and saving for a child's education, again, is it the same sort of idea where you'd want to do a sort of step progression?
Gradual.
Yeah, okay.
Gradual.
Let's talk about a retiree. Retiree is sort of in a more complicated position, I guess, as an investor, right? Like, plugging money into your portfolio is relatively straightforward. Taking it out, that's a different conversation. What do you think their asset allocation might want to look like in their golden years?
Well, in some cases, maybe they will not change their asset allocation, but they'll pass from an accumulated asset allocation to, as an example, a T-series decumulation asset allocation. I really like those because honestly, it allows you to stay invested in your asset allocation, but receiving a higher cash payment. A bit like a pension fund. This is what we do, right? All the year, if you've got if you're lucky, if you've got a defined pension fund, you contributed all the year, you've built your wealth, and at one point you're taking income from it. This is now what asset allocation are doing for you. You can maintain the same asset mix if it still fits your risk profile, but you can begin to accumulate. So instead of, because when I look at the model right now, they're paying, a monthly income less than 2%. So that's not enough. People usually will live up to 4, 5, 6% income. So that's what T-Series allows you to do, is increase your income, maintaining, if it fits well, the same, asset allocation model. So we need to think differently, and sometimes I see people combine them with diversify. I'm insisting diversify, broad, dividend, or cover call ETF.
What about, I guess the question that a lot of retirees have is, like, how conservative do I go in retirement? Like, do I go below 60-40? Do I go below 50-50?
Depends of your age. Like, I'm 62. I still have at least a good 30, 35 years of a bit of accumulation and decumulation phase. But again, it depends too. Are you wealthy? Do you have a lot of income because of a defined benefit? Is your wealth is bigger than your income need? So there's no one-size-fits-all solution. There's our solution, and we need to understand, how our wealth has been created, what is the source of income that we have, and does it allow us to take a bit more equity positioning inside of our portfolios? We should take everything in account.
Yes, that's really well said. I love going through the case studies. Appreciate you playing ball with that because those
it's education. It's not advice.
Exactly.
It's education.
Exactly. These rules of thumb, these guidelines, I think are helpful jumping off points for people. So we appreciate you going through those. And just a quick reminder to our viewers, though, if you want to go back through those case studies and hear this all over again, this will be available for rewatch in the Learning Center on Webroker and TD Direct Investing's YouTube channel in just a few days. So hang tight for that. Before we continue, while you're at it, why don't you follow TD Direct Investing on social media? You can scan the QR codes on screen here to check us out on YouTube, Instagram, Facebook. We've got a ton of fun stuff on there to level up your investing knowledge and entertain you along the way, including some sneak peeks at upcoming live programs that we have, so make sure you check them out. Our live viewer Q&A coming up in just a few minutes, so get your questions in if you haven't already. First, though, I want to bring in my colleague Caitlin Cormier to show us how the Webroker platform can help investors manage their asset allocation over time. Caitlin, welcome back. We missed you last week. We're glad to have you back. Great to have you on the show as always. What tools does the platform have to help with asset allocation?
Absolutely. Happy to be back for sure. Asset allocation, so important to understand what you invest in, where it is within your portfolio. So let's just take a quick look at our asset allocation tool. What this tool does is it automatically will take your accounts within Webroker and break them into these categories specifically. So not even just stocks versus fixed income. It'll take Canadian equity, US equity, international, and it'll also actually break it down even further than that. If you scroll down a bit on the screen, you'll even see it'll break it into different equities. Like, it'll break it in and show you what the underlying investments are in each one of these categories. It'll show you what percentage each one is, any gains or losses. So quite a bit of information there without you having to do a lot of legwork as far as not only, you know, where you're invested, stock versus fixed income, but also which areas maybe you're overweighted, you know, too much in US, too much in Canadian. So you can really have a good idea of where you are and where you want to be.
Okay, so that's a great snapshot of where your asset allocation stands. But of course, as we were talking about, Alain and I, you're going to have to change that asset allocation over time, right? So how can the tools in the platform help you understand what to do next?
Yeah, absolutely. So, I mean, rebalancing, right? You have to be able to take the investments you have and put them into something different to get into line with your asset allocation. So if we look in the platform, if we go through the buy sell tab, one of the great tools, I'm just going to put just kind of a random ETF in here for the purposes of this demonstration. One of the great tools we have is what's called partial shared trading. This just essentially means, and you can always click to find out more information, but it just essentially means that you can trade based on a dollar amount as opposed to a number of shares. So if you're overweighted, if this is the ETF you have for US, and let's just say, you know, you've got, you know, $2,500 too much in that particular ETF, you don't have to put 3 shares or 4 shares. You can put in the actual dollar amount that you want to sell, get out of that piece of the position and transfer it into another area to kind of ensure that you're back in line. So being able to use that partial shares can also really help with making sure that not only is rebalancing easy, but you can do it sort of quickly and easily through the order entry.
Yeah, partial share is a great tool to put every dollar to work and add that extra precision to your portfolio. I appreciate you showing us the ropes there, Caitlin, as always, and welcome back too. We'll see you next week as well. That was Caitlin Cormier, TD Direct Investing Senior Client Education Instructor. And of course, if you want to hear more from Caitlin and Jason, who we had on last week, and all our other instructors, you can check out their live masterclasses to learn more about TD's trading platforms and tools available to help you manage your portfolio. You can scan the QR code on screen to see a listing of upcoming events. All right, Alain, the time is upon us. We're going to open up the floor to our viewers, see what they want to know more about. You ready to get at it?
Yep.
All right, our first question is coming to us from May. Let's see what May wants to know. Could you elaborate on the T-Series funds you mentioned? Who are they best suited for, and in what situations might an investor consider using them? Is it all return of capital? So lots of questions packed in there. Have at it.
I'll begin by the first one. T-Series was existing already in the mutual fund industry. What's innovative is to do it inside of the ETF industry. I still think we're the only one that provides T-Series. We provide it on 3 models that we have: ZBAL.T, ZGrow.T, and ZEQT.T. Why they're helpful, like I was saying, like you're still invested in the same asset allocation, but instead of generating 1.5, 2% return, depending on the model, you know, we're giving you, you know, a monthly cash out based on an annual distribution. What's interesting also, because I see, you know, what are the tax component of it, it can be more tax efficient depending on the nature of the distribution. So it's not all rock, because there's still dividend, there's still interest income, but that could be interesting in a taxable account. So for me, it's really for someone that want to go from accumulation to, this is the real important, to decumulation. So it speaks more about the retirees.
And it helps them, I guess, get a better sense of what they can expect.
It's like having the same experience that if you've got a pension fund.
Right.
In a pension fund, you build your wealth in a pension fund. At one point, you draw income from it. So it's a bit the same, except that the payout is a bit higher than what, you know, the investment inside generates. And I think for some of the T-Series, it makes sense. Again, I'll say to the people to Google the FP Canada assumption rate, because this is where I've used the data for the mortality table. But they also showcase what are the expected return by asset class. So on the equity portion, by the way, it's between 6 to 7% what they do in terms of long-term expectation. So if you've got a ZCon T6, a ZGrow T6 or ZEQT T6, it makes a lot of sense, because that's the long-term expectation we've got on the equity portion. So this is a great, new, innovative way of looking at asset allocation.
Yeah, interesting tool to consider for sure. Let's get to our next question. This one's coming to us from Deborah. In your asset allocation recommendations, how do you incorporate other sources of retirement cash flows, pensions, CPP, OAS, rental income, dividends? Great question, Deborah.
Well, you need to look at where is your wealth concentrated. When I look at Canadian, there's 25% of Canadians that are millionaire by net worth. I don't know if you knew that. 1 family in 4. is a millionaire family in Canada, but people in Canada are really real estate rich.
Yes.
Sometimes a bit cash poor. So there's only 6% of Canadians that have more than $1 million to invest. So you need to look at everything that you own, to look first at your investor profile, but also to look at the strategy of decumulation, because I think that was related to a strategy of decumulation. So I think a T-series, a dividend, a cover call makes sense if you want to combine this to the other source of income that you've got. It's important to look at, are you in a registered account? Are you in a taxable account? So maybe look more into this so that you make sure that you maximize, the benefits of low cost and also tax efficiency. So the right solution and the right, if it's in a registered money or if it's in a taxable account. So be aware of this.
And maybe a follow-up question too. Like if you're, let's say, a retiree and you've got, rental income, you've got your CPP-OAS, all this stuff, should that affect or influence the investment portfolio asset allocation that you have? Like,
if the investors have tax specialists, they could look into that to maximize. Indeed, we do education. We don't give advice on taxes. But what you're telling me is that individuals should pay a bit of fee money to go to see a tax specialist to maximize the tax structure. But asset allocation are there to help you inside of the registered money to maintain the right allocation, but in taxable account, also to maximize the tax efficiency of all the income you're generating. So that's a good idea to go to see a financial planner or a tax specialist to maximize this.
All right. Let's get into our next question. What do we have on tap here? This one's coming to us from Melanie. What are the advantages of using an ETF over a mutual fund with a similar asset structure?
At the same fee, there's no difference. And more, I see the industry bringing some ETF solution in the mutual fund format at the same price. So the ETF, while you need a discount brokerage account or full brokerage account to have ETF inside, which is different on the fund side. But I would say that if it's at the same fee for the same solution, there's no advantage. And I think more and more we're going to see the industry evolve there, like bringing the best of the active solution at the same pricing on the ETF platform. We do that a lot. And bring also the low cost index ETF inside of the mutual fund format at the same pricing.
Interesting, yeah.
So,
a development to watch for sure, yeah. I know a lot of people like the mutual fund aspect of things just for the ability to like automatically contribute and buy and not have to like manually do it. So that's interesting. We'll watch that. Let's get to our next question coming to us from Clyde. What are your thoughts on low volatility ETFs such as ZLB? That's BMO's low volatility Canadian equity ETF. Are they a suitable option for investors seeking lower risk while remaining invested in equities?
Yes, they are. I think it's interesting to combine not just having one factor ETF, but in combination in your Canadian equity sleeves. We see a lot of people pairing, a core index ETF with ZLB or an active diversified one with ZLB. It gives a better risk return profile. And we see people do that also in the other asset class or geographical asset class like US, EFI emerging, because you can have low vol in each of those geographic opportunities. So yes, it makes sense to use ZLB, and long-term, the return of ZLB, but you need to think long-term, has been really good versus the main index, the TSX. So it makes a lot of sense to combine. But I would not just use this, but I would combine it.
Okay.
And the core should be diversified. Sorry if I'm bringing that, but I don't think, when we speak about concentration risk, if I may,
sure,
there's the one stock, there's the one sector, one country, and one asset class. There's as much problem if you're 100% in GICs. You feel protected, but you're going to have a problem with the inflation. You're going to have a problem long-term with generating the growth you need to build the wealth you need. So just having one strategy, not diversified in one country, doesn't make sense. And in Canada, I think it's 50% of the equity that are invested in Canadian equity. So we need to think about diversifying broadly. So, and sometimes in places where we don't want to be, but provide us, great return. Emerging market has provided a lot of great return, but there's not that much people that are thinking about adding a 2.5 or 5% of their asset allocation if they're in a balanced growth or all equity model in that space. This is where asset allocation ETF helps you because you're invested and it's rebalanced, taking the emotion out. More you can take the emotion out of the equation, I think better you're going to have a better return long term.
Yeah, I think Canadian investors writ large are sort of guilty of piling too much into just Canadian dividend stocks and stuff like that. A lot of home country bias. So anyway, so Clyde, I mean, there you go. You're onto something there. Let's get to our next question. Harold and other viewers have this question. What estate planning considerations should investors keep in mind when making asset allocation decisions?
Well, I think that in terms of consideration, retirees, because probably it's a retirees, they should think about funding first their lifestyle. They should think about generating the income they need before thinking about their heirs or the people that are going to inherit those. There's no specific consideration outside to have a good plan and plan accordingly if it's in registered solution or in taxable solution. But first, because I see a lot of retirees thinking, oh, I want to give like some money to my kids. Should I have a more growth profile? I think the profile you have should be the ones that suits you and should fund your lifestyle. This is really important. If you want to help your kids, so ask your parents to give some money for the RSP and invest it in their growth profile when they're young. So that's a great way. But I think retirees, and we see a lot of that, should think about funding, their own lifestyle, because if you're 60, 70, you still have maybe 30, 25 years in front of you. So you need a bit of growth, you need diversification to keep that money kept for the next 25, 30 years.
It always comes back to diversification. I feel like that's always like the golden rule of investing here.
And emergency fund.
And emergency
fund. At any
okay.
age.
Yes.
At any age, this is so key to be able to tackle, the short-term volatility in the market, to not look at the headlines, to keep, invested, have realistic expectation, and you're going to do well.
Some phenomenal rules of thumb to consider. We appreciate you joining us, Alain, and giving us your perspective. Great stuff, and great job answering all those questions.
Thank you for the invitation.
Yeah, some really great questions coming in from people. And that's it too, folks. We appreciate you tuning in as always. Make sure you check out next week's episode because we have a good one for you. We're going to explore whether the 60-40 portfolio needs a refresh for modern times. We got two portfolio managers who are going to be sharing why they believe gold and, get this, Bitcoin could make sense to add to a balanced portfolio. This is going to be a lively conversation. You don't want to miss this one. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks again for watching, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.